The stock market has continued its torrid start to the year after investors priced in a nightmare scenario for the global economy late last year. So what's next now that we've made all this ground back? Brian Nick is the chief investment strategist at Nuveen, and he joins us now. So Brian, let's just start with the persistence of this rally. Has it surprised you? Because I think a couple weeks ago, easy to say, yeah, bounce off the lows, overdue for some kind of rally. But now we're taking out, mid-December, early December levels.
I think there's no question that the swoon we saw in the fourth quarter of last year was partially due to the slowdown in the global economy, which is still here. It persists, but also due to a lot of these semi-random sources of policy uncertainty, whether it was the government shutdown, Brexit, the U.S.-China trade negotiation, what's the Fed going to do? And slowly but surely, at least some of those are getting priced out. So where we had coming into the year in terms of valuations was recession-like valuations on the stock market. The more confirmation that we get that we're A, not in recession, and B, are not going to have some catastrophic policy event that kicks us into recession, the better the markets ought to do. Although this is certainly, the rally has already gone past where we expected it.
Yeah, now you talk about like a recession-inducing policy decision. To me, that sounds like the Fed. Right, like once Jay Powell kind of changed his tune, then it seems like the market was made more comfortable because, as you mentioned, it's not like the global economy has gotten all that much better in the last 6 weeks.
A lot of the rally, though, happened before the Fed decision, right? So January, we were kind of off to the races. Really, after Christmas Eve, we were almost off to the races. And so I think some of it is certainly the idea that the Fed was beginning, at least in its rhetoric, leading up to the January meeting to get more dovish, and then the dovish hammer came down at the January meeting, but also that the odds of a prolonged government shutdown, the odds of a Brexit crashing out, and the odds of the 10% rate that we have on the $200 billion coming in from China is going to go up to 25%, that all the probabilities of those have been going down at different levels and at different times, but they've all been falling.
Brian, I think you're right to point to vague policy indications and how those have moved the market. I still think we're seeing some of that. I mean, just today we're talking about, oh, here's what Trump said about maybe getting a deal with China. We know that trade has overhung the market so much. Do you think there's kind of an overreaction day in, day out to what we're hearing about the U.S. and China coming to the table, and then when we see the market reaction, or maybe we just overplay and overemphasize the reaction we think we're seeing?
I think if there's a silver lining to the political dysfunction that we saw related to the shutdown, it's that it makes the odds of a dysfunctional outcome to the U.S.-China trade negotiations a bit lower. Like, how many times can you see like these sort of stalemates that end up, these two cars like playing chicken with each other actually crash into? It doesn't really behoove you politically to keep having these events occur. So the fact that we had that 35-day shutdown probably makes the administration more likely to want a deal with China, even if it's a relatively small deal that doesn't cover the full scope that some of the advisors I know who have his ear would like to see it cover.
So you're kind of conflating trade and the shutdown, which we have been doing a little bit as well, just like all this Washington news is kind of good. But you've also said that we've run a little bit further than even you thought we would. So has it changed your thinking on anything right now? Just like in the last week, have you been adjusting anything? Have you been talking to clients about like, well, now that we're here, actually, I think this is different.
And this is a familiar place. This is where we were last year at this time. We had already kind of blown past our S&P 500 targets in January,
you've already
February.
lived through it, but then you also had the back end of what happened in December, so you have some knowledge.
Yeah, the two premises that we're working off of is we are inevitably going to be slowing down, not only from an economic standpoint, but earnings growth is going to start to look a lot less good in the next couple of quarters. We could see earnings growth actually be negative year over year for the first and perhaps the second quarter, depending on how the economy unfolds. There's no doubt that the GDP growth in the U.S. is going to slow down as well. So we want to pump the brakes a little bit on how, not necessarily how enthusiastic we are about stocks, but what's the mixture of sector leadership that we're seeing. We're seeing a very cyclically heavy sector leadership so far in the U.S. and actually abroad too. We're fading that a bit. We came into the year not ultra defensive, but we were in non-cyclical tech. We were in healthcare. We were talking about consumer staples as sort of being a middle ground that you can stick to. And I think where we're getting more conviction is on that call, because we haven't seen it play out the way we expected. We've seen the market as a whole run past. And if you don't get some kind of grand bargain with China, if you don't get a sustained increase in energy prices, it's going to be hard for that cyclical-led rally to keep going.
All right, Brian Nick, chief investment strategist at Nuveen. Thanks so much for stopping by.
Thanks for having me.